Did you know that 40% of Americans can't even cover a $1,000 emergency? That's nearly half of Americans living one small setback away from financial disaster. Meanwhile, the U.S. stock market has been the most consistent wealth-building tool for over a century. Here's the truth. The earlier you start investing, the wealthier you can become. And every single year you delay starting to invest is costing you hundreds of thousands of dollars. The stock market is not some complicated casino. It's simple. It's investing and it's ownership. When you buy a stock, you're buying a small percentage of a company. The stock market gives people like you and me the opportunity to become part business owners of companies that we know and love and that we use every day. Think about your favorite companies like Apple, Amazon, Microsoft, Tesla. Instead of just buying products from these companies and being a customer, you could become a part owner by buying a share of that company. So when you buy a stock share, you get a share of that company's growth and a share of that company's profits. Here's why this really matters. Because the US stock market has averaged around 10% growth per year. So on average, stocks in the US are growing. If you invest your money into stocks, your money could also grow with the companies. And yes, there may be dips along the way where stock prices might temporarily go down, but historically, the US stock market always bounces back higher and keeps trending up. Let me help to put it into perspective for you. If you had invested $1,000 into the S&P 500 50 years ago, that would literally be $130,000 today. If you would have kept that same $1,000 in a savings account, it would be worth less than what it was worth 50 years ago because of inflation and rising prices. This is why the retirement accounts you open in the US are directly connected to the stock market. Like a 401k from your job or a Roth IRA you open up yourself. These are not just savings accounts. These are growth engines designed to multiply your money over time. And if your goal is financial independence, flexibility, or security, that doesn't happen by accident. It happens when you understand how to use this tool to your advantage. Here's the truth. The most expensive mistake that you could make in your 20s is not choosing the wrong stock. It's waiting to invest. Waiting to invest might feel harmless. You might tell yourself, I'll invest when I make more money or when life slows down. But in reality, every year you delay is costing you money and time that you will never get back. Because here's the thing about the stock market. The stock market doesn't just reward based on how much you have invested, but the stock market also rewards based on how long you've been invested. Let me prove it to you by showing you two different examples. We have person A who starts investing at 20 years old and contributes $200 a month towards their investments. And we have person B who starts investing at 30 years old and they contribute $400 a month for their investments. Since person B waits until 30, they try to double up their investments to catch up for lost time. Now I'm going to help you visualize the differences in the investment details between person A and person B. Person A and person B both start out with an initial investment of $1,000. And in these cases, we're going to calculate how much they are able to compound by the age that they turn 65 years old. So since person A starts at 20 years old and they're going to compound their investments until they turn 65 years old, and we're expecting a 10% annual rate of return, person A started investing at 20 years old. And by age 65, they have compounded their net worth of investment investments to $1 million, $875,000. They created a net worth of $1.8 million just by investing $200 per month. Now let's compare this to person B, who started investing $400 a month at age 30. How much will their net worth compound to by age 65? Person B's initial investment will be the same as person A's initial investment. The only difference about person B is they have 10 years less of investment growth. But since person B wants to make up for lost time, they doubled their recurring investments. So in this example, person B, who started investing $400 a month at age 30, by age 65, they will have compounded their investments to a net worth of $1,387,000. So by age 65, person A ends up with $1.8 million and person B ends up with $1.3 million. So even though person B invested more cash out of pocket per month, since they delayed on starting their investment journey, they lost $500,000. That is the power of compound interest. Compound interest is when your money makes money and those earnings make more money. Here's how compound interest works in the stock market. The companies you invest in, first they'll grow in value. They reinvest their profits, their stock price increases, and some even pay dividends. As those gains keep building, you're not just earning on your original deposit anymore. You keep earning on top of the gains you've already made. Think of your initial investment deposits as a snowball. When you first start your snowball and you start rolling it downhill, it'll start off tiny and it might even be boring. But as the years pass, that snowball gathers more and more until it becomes unstoppable. Albert Einstein called compound interest the eighth wonder of the world. He said if you understand compound interest, you will earn from it. And if you don't understand it, you will pay it. Here's the most important key. Compound interest works in both ways. If you're in debt, interest snowballs against you. If you're invested, interest snowballs for you. So the choice is simple. Do you want compounding to be working for your future freedom, or do you want your compounding to be working against you? Now let's get practical. How do you actually begin stock investing? Step 1 is open up a brokerage account. In the United States, one of the best beginner-friendly options is Charles Schwab. Go to Schwab.com and click open an account. You'll see these options: an individual brokerage account, a Roth IRA, which is great for young people, and a custodial account if you're under the age of 18. Your Charles Schwab brokerage account is 100% free to open, but keep in mind that this is a US bank. It's a brokerage that's going to allow you to buy stock. So you will need your ID, your social security number, and a linked bank account to make your first deposit. Step 2, fund your account. Start with $20, $50, or even $100. Don't wait to save up thousands. Start with what you have. Think of your brokerage account as a long-term savings account that grows your money. What I recommend to put into your brokerage account is whatever you can afford to invest consistently per month, and add your investments to your monthly budget. Okay, but investing doesn't stop there. Then step 3 is you need to actually buy your first investment. For beginners, the easiest and safest way to start investing is to invest in index funds. For my investments, I focus on tickers that provide stability, liquidity, diversification, and long-term growth potential. First is the ticker SPY. That tracks the top 500 companies in the United States. Instead of trying to just pick one hot stock, you could automatically invest into the best 500 US companies. That will give you instant diversification on your investment portfolio. The other ticker I like is VOO. VOO, the Vanguard S&P 500 ETF. VOO has a lower expense ratio than SPY, so it is perfect for investing. Another ETF is QQQ, that is the NASDAQ 100, the top 100 tech companies in the United States. QQQ is tech company heavy. It is more volatile, but it also has more growth potential. Step 4, stay consistent and set up automatic investments every month. Treat your investments like a bill, and you always want to pay yourself first. This is called setting up a recurring investment. Recurring investments simply mean setting up automatic purchases on a daily, weekly, or monthly basis. By buying consistently, you benefit from dollar cost averaging. That means you buy in no matter if the market is high or low, because it doesn't really matter to you for your long-term investing strategy. With recurring investments and dollar cost averaging, you don't have to time the market perfectly. Over time, you'll be able to buy these ETFs or individual tickers at an average cost. So if you're consistent, the price will smooth out over time. And since the stock market has a consistent track record of growth over time, that's what we're focused on. Now let's talk about US retirement accounts, because these are tools that can supercharge your growth. Quick disclaimer, I'm not a financial advisor or tax advisor. I'm simply sharing how these accounts work and what I personally use. Everyone's situation is different, so always check with a professional before making any big financial decisions. Let's break down the main retirement account options. First, a 401k is an employer-sponsored retirement plan. A 401k is the plan you get through your job. Contributions to 401ks are made on pre-tax dollars, which means you reduce your taxable income now by using a 401k. The best part is many employers will match your 401k contributions. That is literally free money. If your employer offers a 401k match, take full advantage of it and use it. So let's bring it back to the example from earlier. If you are person A who starts investing at the age of 20 and you contributed $200 a month to your 401k, meanwhile your employer is matching your contribution, also contributing $200 a month towards your 401k, if you did that for 45 years until the age of 60, your $1.8 million turns into $3.6 million. That is the power of a 401k with an employer match. If you have that opportunity, do not take it for granted and take full advantage of it. That is literally the difference between ending up a 1.8 millionaire to a 3.6 millionaire just by having your employer match your investments. The second type of account is a Roth IRA, which is an individual retirement account. This one you could open up for yourself outside of work. Contributions to your Roth IRA are made with after-tax dollars. What that means is you'd pay taxes on your income now, but here's the magic. All of the growth and withdrawals you take in retirement will be completely tax-free. That is insanely powerful if you're currently young and in a lower tax bracket, because you're paying taxes on a smaller account today while your account grows tax-free for decades. Third, there's another individual option, which is a traditional IRA. It's similar to a Roth IRA, but here you contribute pre-tax dollars. In this account, your money will grow tax deferred, and you will only pay taxes when you take your withdrawals later in retirement. The biggest mistake beginners make is ignoring the opportunity that comes with these different types of accounts. If you don't have these accounts set up, you are literally leaving free money tax benefits, and decades of potential compounding on the table. Now, personally, I also use a regular brokerage account, which is sometimes called a taxable account, alongside these. That's where I manage my own investments outside of retirement rules, so I have more control over my investments. You can open up one of these brokers with Charles Schwab, Fidelity, Vanguard, even Robinhood. It's literally as simple as opening a checking account, except when you put your money into these accounts and in investments, your money is making more money for you and your money grows for you. So the smartest move you could make today is, after watching this video, figure out how this advice fits into your bigger investment plan. Use retirement accounts for long-term growth and tax advantages, and use your brokerage account for more flexibility and control on your investments. What I've been explaining to you in this video is the safest way to invest in the stock market to see an average annual percent compound growth of 10% per year. Now, you've probably heard of people talk about trading, which is different than investing. Up until now, we've been talking about investing. Investing is steady. Investing is safe. Investing is how you can grow your wealth by 10% on average per year in the stock market. That's the long game. It's very boring, but it's very powerful. Trading, on the other hand, is different. Instead of waiting for years to see your compounding play out, trading allows you to see those effects much faster. The potential gains, losses, and lessons can happen on a daily basis with trading. And here's where they both come together. Trading and investing are in the same arena. They're both in the stock market. Now, inside the stock market, there's a tool called options. Options are simply contracts tied to stocks. One option contract gives you the right to control 100 shares of the company without paying for the full price up front. That leverage is what makes options so powerful. Used wisely, options can accelerate your growth and compounding in a way that stock investing can't. In options, you're still tied to the companies that you know, like Apple, Amazon, and Tesla, but you have the ability to grow your account faster because you could do more with less capital in options. This is why I always tell beginners, investing builds your foundation for long-term and steady growth. Trading options can build income and accelerate growth once you learn how the market moves. So think of it like this. Stocks are your base and your foundation. Options is your amplifier. Together, they give you the ability to grow your wealth both in the long term and the short term. And if you want to see exactly how to start trading options, I put together a full beginner's guide that will walk you through it step by step. Click right here on the screen to see my complete guide to start trading options.